Today, we're taking a deep dive into a new crypto trading engine called AVCap. Now, it claims to have found a way to deliver consistent returns, so we're going to put that to the test. We'll dig into its back-tested performance, see what's really under the hood of their algorithm, and of course, break down the fee structure to see if this is a partnership that's truly aligned with investors. Let's get right into it.
This is really the million-dollar question for any serious crypto investor, isn't it? We all know that the chaos in this market is where the real opportunity is, but how do you actually capture that upside, that alpha, without getting totally wrecked by the volatility? The real challenge is turning that wild chaos into consistent, maybe even predictable returns. Well, this system is claiming it has an answer.
And here is their headline number. This is what they're leading with. According to a 7-month backtest, a hypothetical $1,000 could have grown to almost $39,000. Now, that's a mind-blowing 3,780% return. Of course, a number like that, you have to be skeptical. So let's dig in and see what's actually behind it.
So, here's how we'll break it down. First, we'll get a handle on the core idea. Then, we'll really scrutinize those performance numbers. After that, we're going to look under the hood at the algorithm itself, see how an investor actually gets started, and finally, and this is key, we'll analyze the fee structure. Because for any investment, that's where the rubber meets the road.
All right, let's start with the big picture. Section 1. What exactly is this new engine for crypto? And how on earth does it plan to tame the absolute chaos of the digital asset market? Yeah, anyone who's ever tried to trade crypto knows this feeling deep in their bones. The market literally never sleeps, it's incredibly volatile, and trying to trade manually often just leads to burnout and, let's be honest, emotional mistakes. Trying to stay disciplined enough to profit consistently, it feels almost impossible for a human being. So the solution they're proposing is a system that's built to get past those human limits. It's fully automated, which is huge because it takes emotion and bias right out of the equation. It's quantitative, which just means it runs on cold, hard data and rules, not gut feelings. And maybe most importantly, it's built with institutional risk controls. That signals a professional approach that's focused on protecting capital, not just gambling for huge returns.
Okay, so that's the theory. Now for Section 2, let's actually decode the performance. And just so we're clear, we're looking at back-tested results from a 7-month window between September 2025 and March 2026.
These monthly numbers are obviously staggering. But from an investor's point of view, the most important thing to see here is the consistency. According to this data, that's 7 profitable months in a row. That suggests it wasn't just some lucky, one-time bet. It seems it was able to adapt and find profit month after month. And that, right there, is the holy grail of trading.
Raw returns are one thing, but professional investors always look at risk-adjusted performance. The Sharpe and Sortino ratios basically tell you how much return you're getting for the amount of risk you're taking. Higher is always better. And the profit factor is even simpler. How many dollars did it make for every dollar it lost? Seeing these kinds of institutional metrics tells you this isn't just some retail trading bot. It's a system designed to be evaluated like a professional hedge fund.
And here we have the all-important disclaimer. This is absolutely critical for any investor to understand. These are back-tested results, which is a simulation using old data. And while it can be a really powerful clue about a strategy's potential, it is never, ever a guarantee of future profits. The fact that they're so upfront about this is actually a good sign.
Okay, so the performance claims are definitely compelling. But the big question is, how does it actually work? So in Section 3, we're going to pop the hood and see the mechanics of this trading engine. So this 6-stage process shows that there's a lot more going on than just a simple buy low, sell high script. It actually starts by classifying the market, basically figuring out what kind of environment it's in. Then it routes to the best strategy. But crucially, before any trade is made, it goes through a risk architecture. After a trade, an AI journal even analyzes what happened to find ways to improve, and this all runs around the clock. It's a closed-loop system designed to constantly learn and manage risk. At the very core of this engine are 2 completely different algorithms. Think of Algorithm A as the workhorse. It's a trend-following system that's designed to catch momentum. Then you've got Algorithm B, which is more of a specialist. It looks for opportunities when the market gets stretched too far in one direction. Using 2 different systems like this is a classic way to diversify, making sure the engine has a tool for the job, whether the market is trending hard or just bouncing around sideways. So, we've seen the performance claims and the tech behind it. The next logical question for any investor is pretty simple. How do I get in? That brings us to Section 4, which covers the onboarding process and how the investment pool is set up. It looks like they've really designed the process to be as simple as possible. You create an account in, 30 seconds, deposit funds using standard stuff like Binance Pay, and then you can track everything in real time on a personal dashboard. It's clearly built to be accessible to a wide range of people, not just big institutional players. Okay, let's break down the key features for an investor. That $200 minimum is a really low barrier to entry, which opens this up to a lot more people. You get monthly withdrawals after a short 30-day lockup, which seems fair, but honestly, the real standout here is the promise of full transparency on all trades. For an investor, being able to see every single move, that is absolutely critical for building trust.
All right, now for what might be the most important part of this whole breakdown. Section 5, an aligned partnership. This is all about the fee structure, because this is what tells you if their interests are truly aligned with yours. And the fee structure is incredibly simple and very investor-friendly. Check this out. There is a 0% management fee. 0. That means you're not getting charged just for having your capital sit in the pool. The only fee is a 15% performance fee, and it's only charged on profits. The message here could not be clearer. If you don't make money, they don't make money. Period.
And that performance fee comes with a critical piece of investor protection called a high watermark. It's actually pretty simple. Let's say your account grows to a peak of $1,200 and then drops to $1,100. You won't pay any performance fees until your balance not only recovers but goes past that previous $1,200 peak. It makes sure you never pay a fee twice on the same gains, and it's pretty much the industry gold standard.
And this quote just nails it, doesn't it? When you combine a 0 management fee with a performance fee that has a high watermark, you create a really powerful alignment. Their success isn't just a promise, it's mathematically locked to the investor's success. So let's just recap the key takeaways here for an investor. First, you've got a systematic, automated approach that's designed to take emotional errors out of trading. Second, you have some very impressive back-tested performance figures. Third, it's structured for full transparency. And maybe most importantly, you have that 0 and 15 fee structure with a high watermark that really creates a true partnership.
Which leaves us with a final question to think about. We've seen the potential of automated strategies to try and tame the chaos of crypto, and it's wrapped in a structure that seems truly aligned with investor interests. As this kind of technology becomes more common, the real question isn't if you should be paying attention, but rather, what role could a system like this play in your own investment strategy? Something to think about.